Today, we will talk about the definition and working principles of hedge in investing. In finance, hedging means taking an offsetting position in an asset or investment to reduce the price risk of an existing position. It's like taking out an insurance policy to protect against potential losses. This trade is made to reduce the risk of adverse price movements in another asset, usually by taking the opposite position in a related or derivative security. Using a hedge is similar to taking out an insurance policy to protect your home from flooding. It's a way to mitigate potential dangers from adverse price movements in the market, but it comes with trade-offs. While it reduces risk, it also limits potential gains. Investors and money managers use hedging to reduce and control their exposure to risks, and it involves using various strategic instruments to make another investment in a targeted and controlled way. Derivatives are financial contracts whose price depends on the value of an underlying security. Futures, forwards, and options contracts are common types of derivatives used for hedging. The effectiveness of a derivative hedge is expressed in terms of delta, or the amount that the price of a derivative moves per $1 movement in the price of the underlying asset. A common way of hedging in the investment world is through put options, which give the holder the right to sell the underlying security at a preset price on or before the expiration date. For example, Morty might hedge his investment in a stock by buying a put option that gives him the right to sell the stock for a predetermined price. This way, he can protect his investment from potential losses in the market. Another way to hedge is through strategic diversification of a portfolio to reduce certain risks. This involves investing in different assets that may move in opposite directions to reduce overall risk. While it may not be as precise as using derivatives, it is a way to provide some protection against potential losses in the market. In the index space, moderate price declines are common and unpredictable, leading investors to use spread hedging as a strategy. This type of spread offers a degree of price protection and is often sufficient to cover a brief downturn in the index. Hedging is a technique used to reduce risk, but it's not a guarantee of future success and doesn't ensure that any losses will be mitigated. There are downsides to hedging, and it's important to weigh the pros and cons when considering a hedging strategy. While many everyday investors may not actively use hedging strategies, understanding the concept is useful for tracking and comprehending the actions of larger financial entities and investors who do engage in hedging practices on a regular basis. It allows individuals to better understand the dynamics of the market and investment strategies. Hedging is a strategy that tries to limit risks in financial assets. It uses financial instruments or market strategies to offset the risk of any adverse price movements. Put simply, investors hedge one investment by making a trade in another. Examples of hedging include purchasing insurance against property losses, using derivatives like options or futures to offset losses in underlying investment assets, or opening new foreign exchange positions to limit losses from fluctuations in existing currency holdings while retaining some upside potential. In investing, hedging is complex and thought of as an imperfect science. It's not a guarantee of future success and often involves trade-offs. A perfect hedge is one that eliminates all risk in a position or portfolio, but even the hypothetical perfect hedge is not without cost. Hedging is an important financial concept that allows investors and traders to minimize various risk exposures they face. A hedge effectively offsets or counteracts the potential losses in a position or portfolio, acting like an insurance policy. The most common and effective hedge often involves the use of derivatives such as futures, forwards, or options contracts. Here are 4 key takeaways. 1. A hedge is a strategy that seeks to limit risk exposures in financial assets. 2. Popular hedging techniques involve taking offsetting positions in derivatives that correspond to an existing position. 3. Other types of hedges can be constructed via other means like diversification. An example could be investing in both cyclical and countercyclical stocks. 4. Besides protecting an investor from various types of risk, it is believed that hedging makes the market run more efficiently. Hope this would help. Thanks for watching.